Hey guys, hope you had a great long weekend. Kicking off right away with Palantir. So breaking it out of this little wedge and pushing toward the upside. We want to see Palantir break above 2750. Once that happens, looking for a gap fill at 3134 area back from February 12th. Looking very bullish in the chart. Nice consolidation over the past few months. Ways to play it. If you want to play Palantir, looking at leaps is not a bad idea, as the price should appreciate a fair bit over the next few years. And the 20s will probably seem very cheap at that point in time. So looking at Palantir right now, if you're going out shorter term, again, I wouldn't trade shorter term, but if you're playing the breakout to 30, which could happen any week, it might happen in a few days, you can do that as well. Looking at next Friday's expiration for the monthly OPEX, the current expected move is about $1.50 in one direction, so 28 upside, 25 downside. But looking at it longer term, if you want to trade to January or January 2023 instead, 2022, you can go with in the money call options. You're paying pretty much 80 cents of extrinsic value, and that's not too bad overall. Getting a position that's equivalent to owning 100 shares of Palantir stock, right? So if you were to buy the 20 strike, for example, you get a 0.85 delta. You get a break-even price of 27.40 or so right now, and the current price obviously is 26.70. So not too much extrinsic premium you're paying for that contract. You only have September, October, November, December, and January, so you have about 5 months. You get another earning report. I don't think you get two reports. I'm pretty sure it's just one report you get. But either way, we should be trading well above 30 bucks by expiration. So not a bad look for this expiration date. If you want to go further out as well, you can look at going to January 2023. Again, the premiums aren't that high right now, even if you're buying in the money. So for example, if you were to buy the 20 strike for 2023, a year and a half out almost, you're paying about 970 premium. So break even is 29.70. Let's say we're trading at like 55 bucks or 60 bucks come this expiration date. You've made basically 300% return on this position right here, right? It's a much more capital efficient position to take than buying the stock, assuming that you're selling poor man covered calls. If you do own the stock and you want to generate premium, when the premiums are high, it's nice to sell covered calls, but obviously when premiums are lower, it's better to just own call options that are leaps and essentially ride those out into the sunset as it rises in price, right? Keep in mind that December 30th roughly is the 1 year date from when they did a direct public offering. So that's the 1 year date from when I started trading. And looking bullish on all fronts. I think Palantir is going to do very well in the long run. One of my favorite stocks right now, favorite companies right now, great management team, wide moat, good margins as well. They're already operating profitably if you factor out the stock-based compensation, which a lot of people are critiquing, which I think is a misplaced critique, given that they're going to be retaining talent with those shares, right? So they have eight-year lockup periods on their stock, which is great because it means that employees have to work for them for 8 years if they want to vest all their shares, right? But again, yeah, long term right now, you can trade it 2023. I believe after the September OPEX, they will open up 2023 June contracts. I think that's the schedule right now. So if you want to wait a few weeks, a couple of weeks, you can probably wait and catch that further out expiration date. But there won't be much liquidity there, so keep that in mind too, right? Now moving on from Palantir, we're going to look at SPY and the Qs. I'm not looking at much else right now. I'm kind of taking it easy and watching the market because I think we're due for a little pullback. But looking at, 1 second, sorry guys, let me change screens here. Looking at Qs, here's the chart looking at. So looking at the Qs right now on the 1 year chart, getting a bit overextended here. We haven't really had many pullbacks. We had a little pullback from 369 down to 359. So about a 2.5% pullback over there. Now we're at 381 and change. Apple has their event in a couple of weeks. Usually Apple sells off after the event, so that could be a catalyst of the downside move as well. Also, there are, I believe it's 8 million Americans that are losing their There's stim checks this coming actually as of today. So that can be a minor catalyst as well. But looking at it from a perspective of trading put ratio spreads and managing your risk that way by trading downside, it's not a bad idea to look at bearish positions, especially when you're holding a lot of bullish positions at the same time, just to kind of even out your portfolio in the event we get a pullback. You don't want to see your portfolio pull back and then take, 3-4 months to get back to where it was, right? So little hedges that can work nicely are put ratio spreads, even going out as far as October, for example. So as an example, and this can be applied to SPY or IWM, whatever you choose, pick your poison. But everyone says you can't time the market, and that's true. But what if you could trade downside protection and have zero debit, for example, right? So let's look at this from an analytical standpoint, right? So current price is 382 roughly. Expected move for October 15th expiration date, which is about 40 days away, is roughly $16 in one direction, right? So downside would be approximately 366 from the current price, right? Let's go down to there right now. If you notice, the put options are about $4. If you go up 16 bucks to 396, notice the calls are $1.84 or so, right? You might be wondering, why are the put options double the price of the call options? Well, that's a simple answer to the question, which is that markets fall much faster than they rise, which is why put premiums are much more juiced. Also, put to call interest 2.18, which means that there are 2.18 puts being bought per call option being bought right now. And also couple that with the fact that puts are bought as insurance by funds that hold large positions in these ETFs. So premiums are naturally much more expensive, which is also why buying puts longer term is not a great proposition, because if you fail to catch the move in your time frame, you lose, right? So looking at the expected move downside of 366, if you were to go long here, for example, right? Let's say you bought the 366 put option for $4.20, right? And then you were to go out further 16 bucks down to 350, for example, right? Selling two of these contracts at 350 right now. What happens here? You have a net credit of about 50 cents. That means you're paid $50 for this position right here. Keep in mind, you're long one put option, strike price 366, and you're short two put options, strike price 350, right? For about a month and a half out, right? So your spread width is $16 wide. Your upside on this trade is $16 plus a credit receipt of 50 bucks. So $16.50 roughly. And your downside obviously is theoretically from 350 minus 16, so 334 to zero, right? So 33,400 bucks. That's a theoretical downside, assuming that NASDAQ went to zero by October 15th, which is very improbable, right? So let's see what happens in a few events, right? If NASDAQ is flat, you win 50 bucks. If NASDAQ goes up at all, even a little bit or a lot, you win 50 bucks. If NASDAQ drops 3 or 4%, you win 50 bucks. Now, if NASDAQ drops from the current price, which is 382 on the Qs, right, down to, let's say, for example, 350, right? So 350. So that move would be a move of 8.4%, right? If we decline by 8.4% over the next month and a half, you would make $1,650 on one contract long and two short on this put ratio spread, right? Now, let's say, for example, it falls a bit further than that. But keep in mind, looking at the charts over the past few years, I pull up the charts right now and look at them, right? We haven't had many drawdowns of greater than 10% outside of the COVID crash, right? So looking at the 5-year chart, you can see we had the COVID crash over here, 30%, which occurred in a month. Recovery took about 4 months or so, right? We had a pullback back in September 2020 as well, 14.3%, happened over about 3 weeks. And recovery is pretty swift as well. We had a pullback of about 10% over in October of 2020 as well. We had a pullback of 12.5% in February of this year. We had a pullback of 8% in May of this year. And since then, we haven't had any pullbacks at all that are worth mentioning, really, right? 4%, 5% pullbacks, nothing crazy. So going back to the option chain again, right? And analyzing what could possibly happen on the downside. So if the NASDAQ were to pull back from the current price, 382, let's say it drops 10%, right? That brings us to 343.80 on triple Qs, right? What would happen to this position over here? Well, if we fell to 344 for argument's sake, right? You would essentially make on your long put option, you would make 22 bucks. You would lose $6 times 2 on your short puts, right? So 22 minus 12 is 1,000 in this case, or sorry, 10 times 100, which is 1,000. So you make $1,000 plus you credit of $50, 1,050. If the Nasdaq were to fall 10% by October 15th, right? Just think about that. Furthermore, your break-even point would be your spread width over here, which is 16, subtracted from the middle strike over here at 350. So if it went to 350 minus 16, which is 334, that would be your break-even point on the trade, at which point you still make $50 for your credit over here. So in order for you to lose on this trade, essentially the Nasdaq would have to fall. I'll tell you that right now. 382 times, one second, sorry. It would have to fall 13% in the next month and a half in order for you to lose on this trade. So if it's flat, if it goes down a little bit, it goes down 10%. If it goes up at all, you win on this trade. Now, obviously, the downside is if we do get some kind of serious crash of 30% or 40%, which is improbable, but also possible, you could lose a lot more money than that, obviously, right? So keep that in mind. Just some food for thought on how to trade the downside in the market using put ratio spreads. You need to have a margin account to do this, obviously. Make sure you understand what you're doing before you actually use one of these trades, because obviously if you don't know what you're doing and you use them inappropriately, they can burn you pretty fast. That being some easy tips here, guys, look for high liquidity. So Qs, SPY, IWM, they all have high liquidity, right? Lots of open interest, lots of volume. Tight spreads, very important. Secondly, you want to buy some time. So a month and a half in this case. Thirdly, you want to look at buying out of the money, not at the money or in the money. Because the whole idea here is that you have a put ratio spread in place. If the market doesn't fall at all, you don't care. You're receiving a credit here. So if you're long, Apple, Microsoft, Palantir, Nvidia, whatever, and the market chugs up, you're winning on your long positions. If the market crashes, not crashes, but dips, let's say 10%, you're going to lose short term on Apple, Microsoft, Nvidia, Palantir, so on and so forth. But your put ratio spread will pay very nicely, right? The only way it'll pay poorly is if the dip is much, much more than a dip and more so a crash, right? That being over 13% in this case, right? Obviously, you can play around with the numbers, do wider or narrower. I would say wider is very important. Going too narrow can be a problem as well. And focus on being delta neutral, right? Which means that your overall position on exposure to delta should be 0 or even slightly negative, which results in a credit in this case, right? So for example, if you're long 0.25 and you're short 2 times 0.13, you're net negative by 1 delta point, right? So if you have any questions at all about that, drop them in the comments below and I'll respond when I can. Same thing can be applied to SPY as well. And the last thing I'm going to talk about here is Apple, as Apple broke out nicely last week. And I think they have a little bit more upside before their event, but we might see a pullback beyond that event itself, right? So looking at Apple in the option chain here, closing price on Friday was near all-time highs. IV is a bit elevated because of their event coming up, right? It should be next week on Tuesday or so. So not tomorrow, but a week from tomorrow. And the expected move for next Friday is currently roughly $5 in one direction. So upside 160 or so, downside of 150 or so, right? Liquidity is very good, obviously, in Apple's option chain. I'm going to wait probably till after the event because I already played the upside from 147-ish to 154-ish. I'm going to wait till after the event and play the dip and possibly go long into earnings after that. But that's my own strategy there. There are a number of ways to play it, but I would say given that the IV is a little bit higher right now, using spreads makes a lot of sense. You want to trade upside on Apple for next week. Keep in mind it's kind of a binary play because it's shorter term, only 90 till expiration. But you could trade, for example, the 155, 160 call spread. That's not too bad. Break even point is around 156.50. Sorry, that's a wrong position right there. Long 155, short 160 right there. and debit is about $1.40 or so. Break even is 156.40 there. Downside, if you want to play downside, obviously you can do the same thing. Simply buy, out of the money or at the money if you wanted to. But again, if you're trading the put ratios on Qs or SPY or Russell, that's your hedge for a pullback in the market, right? and also remember that given that we're a very, very top weighted market right now, Apple, Google, Amazon, Facebook, Microsoft, these names carry the market. So if we get a pullback in tech, the whole market will follow suit as well, right? Otherwise, not really much else I'm looking at this week. I don't want to talk about ideas just for the sake of talking about them and blowing smoke. If I see anything interesting, I'll post it next week. But otherwise, if you have any questions, drop them below or shoot me a DM in Discord. Thanks for watching and have a great day. We'll drop some Q&A right now. All right, guys.